90% of day traders lose money. 90% of new businesses fail within a decade. A single index fund, left untouched for 30 years, has outperformed the majority of professional fund managers. These facts are not hidden. They are published, cited, and ignored because the brain does not process a slow, certain outcome the same way it processes a fast, exciting one. You already know roughly how wealth is built. What you don't know, what nobody stops to explain clearly before the sales pitch ends, is exactly what each method extracts from you before it delivers anything meaningful back. The first method requires almost nothing from you. You open a brokerage account, buy a low-cost index fund that tracks the broader market, and then you do something that sounds simple and proves genuinely difficult. You leave it alone. That's index investing. Your money buys fractional ownership in hundreds of companies simultaneously. When those companies grow, and historically, over long enough periods, they do, your balance grows with them. The mechanism is compound interest, which sounds gentle and textbook until you actually run the numbers. $10,000 invested at the market's historical average annual return of roughly 10% becomes not $20,000 in 20 years, but $67,000. The growth is invisible for years, then suddenly it isn't invisible at all. It looks like money appearing from nowhere. It isn't. It's time working without you. The number that makes this real is not the return percentage. It is the length of the runway. 10 years produces modest growth. 20 produces dramatic growth. 30 produces a number that doesn't look like the result of monthly contributions. It looks like a mistake. At the peak, the experience is almost disorienting. Money arrives in your account while you sleep, while you work, while you sit in traffic. The number climbs without your involvement. It feels passive because it is. Then comes the actual cost, and it isn't financial. It's psychological. Index investing demands years of watching your balance decline during market downturns without selling. It demands the particular discipline of sitting still when everything around you says, move. The average retail investor underperforms the average index fund, not because the fund is sophisticated, but because the investor keeps intervening, buying high, panic selling low, chasing whatever performed best last year. The method works. The person keeps overriding it. The method's only requirement is that the person stop making decisions. That is harder than it sounds. Inaction looks like passivity. Wealth treats it as patience. High-income skills operate on a different mechanism. Here, the asset isn't capital. It's knowledge so specific and scarce that the market pays a significant premium to access it. Software engineers, tax attorneys, data scientists, surgeons, consultants who solve one narrow problem better than almost anyone available. The logic is straightforward. When supply of a skill is low and demand is persistent, the price rises. You become the supply. At the peak, the return feels disproportionate to the hours involved. A single engagement, a single project, a single day of specialized work represents more income than a week of generalist labor. The leverage feels real because it is real. Then comes the structural ceiling. High-income skills produce income. They do not automatically produce wealth. You are still exchanging time for money at a dramatically higher rate, but the fundamental transaction hasn't changed. The moment you stop working, the income stops with you. There is no compounding, no asset appreciating in your absence, no equity accumulating overnight. Physicians and attorneys frequently retire with less accumulated wealth than their income would suggest, because high earnings were consumed rather than converted into assets that could eventually replace the earnings. The skill creates an income. Converting that income into something that grows independently requires a separate decision most high earners delay until it's expensive to have waited. Real estate sits closer to the ownership end of the spectrum. You acquire a property, place tenants whose monthly payments service the mortgage and generate a surplus, and wait. Over time, the property appreciates while the mortgage balance shrinks. The bank's money built the asset. That asymmetry is leverage working in your favor. A 20% down payment controls 100% of the asset's upside. At the peak, the cash flow is tangible and recurring. A deposit arrives every month. The work required to receive it diminishes once the systems are in place. Two forces move simultaneously: debt decreasing, value increasing. The gap between them is yours. You did not earn that appreciation through labor. You positioned yourself correctly and waited. The tenants paid for the asset. Time paid for the growth. The rent check arrives the same whether you spent the month working or traveling. But leverage cuts in every direction without sentiment. The same mechanism that amplified your gain amplifies your loss when a market softens, when vacancy rates climb, when a roof fails in the third year. Real estate is illiquid in ways financial assets are not. You cannot sell 20% of a property to cover a shortfall the way you can liquidate a portion of a fund. The transaction costs are high, the exit is slow, and a single problematic tenant or a single year of negative cash flow can erase months of gain. The method creates wealth for people who understand the leverage. It destroys it for people who understood only the upside. The methods above have one thing in common. They are documented, widely available, unglamorous, and slow. Slow is not a flaw in the method. Slow is the method. It is also the quality that makes these paths invisible to most people, because slow does not produce a thumbnail. The YouTube algorithm does not reward compound interest. The course industry does not profit from teaching you to wait. The gap between what builds wealth and what gets attention is not accidental. It is structural. Understanding that gap is more valuable than any single method on this list. Entrepreneurship is the path that does. And of every method on this list, it contains the highest ceiling and the most honest relationship between effort and outcome. Eventually, when it works, nothing else compares. A product that sells while you sleep, a service that scales without adding proportional labor, a business that becomes an asset someone else wants to buy. The mechanism is real. The returns, when they arrive, are asymmetric in ways that no salary structure can replicate. What the success stories omit, the ones on podcasts, the ones in Forbes, the ones shared in every entrepreneurship community online, is the period that preceded the outcome. The years of building with no revenue confirmation. The versions of the product nobody wanted. The customers who signed up, tried it once, and left. Every founder who eventually sold a company for life-changing money can describe in precise detail the 18 months where nothing worked and quitting looked rational. That period is not the exception, it is the process. The mechanism inside entrepreneurship is margin multiplied by volume, multiplied by retention. You create something once, a product, a system, a service delivery model, and then sell it repeatedly without rebuilding it each time. The labor is front-loaded, the return is back-loaded. This is the structural difference between a business and a job. A job requires your presence each time value is delivered. A business continues delivering value after your involvement has stopped. At the peak, this looks like the purest form of wealth creation available to an individual without inherited capital. A software product with 1,000 paying customers generates revenue every month without the founder touching it. A consulting framework once built serves client after client without starting from zero. The business becomes a machine. The founder becomes the person who designed the machine, not the person who operates it every day. That distinction contains the entire model. Then the turn arrives, and it arrives quietly. 90% of new businesses do not survive their first decade. The ones that do survive often do so because the founder absorbed costs, personal, financial, relational, that don't appear in the success narrative. Years of below-market salary, relationships strained by unavailability, health decisions deferred because the company needed the hour more. The compulsion to keep building doesn't stop when the business starts working. It intensifies. One more product launch, one more market, one more pivot toward a segment the current model isn't reaching. Entrepreneurs redose. The high of building is chemically similar to the high of the early days, but it requires increasing output to produce the same result. The business grows. The founder rarely stops to ask whether they are building something or feeding something. Content creation and social media monetization sit at the extreme accessible end of entrepreneurship. The startup cost is near zero. There is no inventory, no office, no minimum viable product beyond a phone and a perspective. The mechanism is attention converted into audience, and audience converted into revenue through advertising, sponsorships, products, or subscriptions. Theoretically, it is open to anyone with a connection and something to say. Practically, the timeline before monetization is longer than most people expect and shorter than most people's patience lasts. The platform rewards consistency before quality, and consistency over 18 months without income requires a tolerance for negative return that most people underestimate before they begin. The economics of a single successful piece of content are genuinely asymmetric. A video that connects with an algorithm can generate tens of thousands of dollars from work that took one day to produce. That number is real. What is also real is that it typically arrives after 18 months of producing content that earned nothing. Not because the content was poor, but because distribution compounds the way capital does, and the early period produces almost no signal. The creator who quit in month 11 will never know whether month 12 was the inflection. At the peak, the creator earns while doing something else entirely. Old content monetizes. New content builds on an existing audience. The machine runs without the daily input that originally launched it. What the platform promoted as a creative path is, for the people who make it through the accumulation phase, closer to a publishing business than a content channel. The distinction between creator and owner is the one that determines what happens when the algorithm changes. Then comes the structural dependency nobody discloses clearly enough. The algorithm that distributed your content can redistribute it overnight. Platform policy changes without announcement. Audience attention migrates to the next format, the next platform, the next creator who understood last quarter's optimization first. The creator who built a business on one platform owns nothing, not the audience's contact information, not the distribution channel, not the relationship itself. The income is real. The asset is rented. That distinction matters when the platform decides your content violates a policy you didn't know had changed. The line between building a business and becoming addicted to building one is thinner than most founders will acknowledge. The same drive that sustains a founder through the difficult early years produces the inability to step back once the business no longer requires constant input. The company scales. The founder doesn't. That is not a character flaw. It is the mechanism. Day trading arrives at this point dressed as the most logical extension of everything above. If wealth is built by owning assets that grow, and if markets price those assets continuously, then surely a person who understands those prices better than average can extract consistent returns by moving in and out of positions at the right moments. The logic is clean. The terminal feels powerful. You open the platform and the numbers are alive. Green ticks, red drops, volume bars climbing in real time. Watching prices move produces a sensation difficult to describe as anything other than stimulating. Patterns seem to emerge from the data. The conviction builds that you are reading something others are missing, that your next position is the one that confirms the edge you believe you have found. Energy sharpens, focus narrows. The world outside the screen recedes. The position feels meaningful in a way that most work does not. Because your money is attached to the outcome, and money makes attention feel like skill. The feeling is real. The inference from that feeling, that you are good at this, that this is repeatable, is where the problem takes hold. The mechanism, in theory, is price discovery. You identify an asset priced below its near-term value, enter a position, and exit when the market corrects. In practice, the market you are trading against is not populated primarily by individuals making the same analytical errors you are correcting. It is populated by institutional algorithms executing millions of trades per second with data feeds, latency advantages, and risk models that no retail trader can replicate or access. You are not competing against other people reading charts from their apartments. You are competing against systems built by engineering teams and funded by firms with balance sheets larger than most national economies. The feeling of reading the market correctly is not evidence that you are reading it correctly. It is evidence that the last trade worked. Those are different things. The market does not distinguish between the two, and neither does the account balance until it does. The statistics on retail day trading are consistent across markets, regulators, and decades of data. Approximately 70 to 80% of retail day traders lose money on a long enough timeline, not because they are unintelligent, not because the method is theoretically impossible, because the structural disadvantages, latency, information asymmetry, transaction costs compounding across hundreds of trades, accumulate silently until they don't. The winning traders are real. They exist. They are also a small enough percentage that the industry that profits from their trading volume has no incentive to tell you which group you are in before you find out yourself. Cryptocurrency begins as the most compelling pitch on this list. In 2021, a single token called Solana returned over 10,000% in 1 year. Stories like that are not fabricated. They happened. The mechanism, or at least the mechanism as most retail participants experience it, is momentum. Price rises attract attention. Attention attracts buyers. Buyers push price higher. The narrative builds around the rising price rather than the underlying value, and the narrative becomes self-sustaining until it isn't. At the peak, the feeling is electric. You are holding something that is genuinely going up, in real time, faster than anything you have ever owned. Every chart tells the same story. You got in early. Then the momentum reverses. Markets driven by sentiment rather than cash flow revert with the same speed they rose. The people who captured the gain were early. Most retail participants were not early. They were the liquidity the early participants needed to exit. Multi-level marketing and get-rich-quick schemes occupy the final position on this list, not because they are rare, but because they are structurally identical to everything above, with one critical difference: the underlying asset doesn't exist. The pitch contains all the elements that make the legitimate methods compelling: community, asymmetric upside, the sense of being early in something real. The product is the promise. The business model depends on recruiting the next buyer before the previous one realizes that the return is not coming from a business. It's coming from them. The brain processes a 10,000% return and a 10,000% promise the same way. That is the entire business model. Everything on this list that produces durable wealth operates on the same underlying mechanism. Index funds, real estate, high-income skills, entrepreneurship, content creation. They are structurally different. They require different inputs, they carry different risks, and they produce different timelines. But they are built on identical foundations. The mechanism is ownership, not ownership in the abstract motivational sense, but in the specific legal and financial sense. You hold an asset that generates returns or appreciates in value independent of your continued labor. The income you earn from working is real. Without conversion into ownership of something that can grow without you, that income does not compound. It depletes. The distinction between income and wealth is not semantic. A person earning $200,000 a year and spending $190,000 has a high income and negligible wealth. A person earning $60,000 a year and systematically converting $20,000 of it into assets that compound over time is building wealth. The number that matters is not what moves through your account. It is what stays. Every method that works, everyone on this list with a real long-term track record, requires a period during which it returns nothing. The index fund requires years during which the account may decline before it recovers. The rental property requires months of vacancy, repairs, and carrying costs before it cash flows reliably. The business requires a period of negative salary before it generates margin. The content channel requires 18 months of uncompensated output before the algorithm decides to distribute it. The high-income skill requires years of below-market work while the expertise accumulates. None of this is hidden. It is in the historical data of every asset class and the first-hand account of every founder who has spoken publicly about the early period. It is simply not the part anyone chooses to highlight. This period is not a flaw in the method. It is the cost of admission, and it is the cost that most people are not willing to pay at the moment they encounter it, because the cost arrives first and the return arrives later, and the timeline between them is longer and less predictable than the pitch suggested. The methods that don't work, the schemes, the speculation, the promises of asymmetric upside without an underlying mechanism, also have a cost period. It arrives after the peak rather than before. The return comes first, briefly and seductively, and the cost follows. That inversion is not accidental, it is the design. What separates the people who build durable wealth from the people who spend decades trying is not intelligence. It is not access to information, because the information is freely available and always has been. It is not even capital, because index funds are accessible on any income. Real estate can be started with less than most people assume, and content creation requires none. It is not connections, though connections help. What separates them is the willingness to absorb a sustained period of negative or zero return, while the underlying mechanism is doing its work invisibly, and to continue absorbing it without evidence that it will eventually resolve. The market pays for patience because patience is genuinely scarce. Most people will sell a declining index fund before it recovers, because loss feels more urgent than gain in the same magnitude. Most people will quit building before the distribution kicks in, because effort without feedback is psychologically expensive. Most people will exit a business in the year before it would have worked, because the signs of progress are harder to read than the signs of failure. The methods are not the bottleneck. The person holding them is. Wealth, ultimately, is the accumulated result of converting earned income into owned assets and then tolerating the period between the conversion and the return. That period is the product. The return is what you receive after you have paid for it in full. The path that promises to shorten that period is the one that eliminates the return instead. The asset that offers the single fastest route to financial freedom always extracted the highest cost before it delivered anything back.